Welcome to Theo Trade. This is Don Kaufman. October 19th, 2022. Just about 15 minutes to go to the cash close here on this Wednesday afternoon with the SPOOs down just about 33 handles. We're going to discuss here on this evening's video the range that really defines all markets. Let's jump right into it. If you're looking at the S&Ps right now, you kind of think to yourself, all right, kind of selling maybe a little bit lower. Nevertheless, one of the first things I want to bring up before we start talking about the range again that defines the markets right now, we need to discuss the fact that huge amounts of the price action in markets are presently happening, okay, overnight. So pre-market, overnight hours, if you're looking at the S&Ps, I mean, these things were explosive to the upside and came off pretty much all throughout the course of the morning. The reason I'm mentioning that is, well, it is cause for concern. It's cause for concern simply because take a look at the tape. Like, what's a real standout? And that's something that as traders, we always kind of want to just eyeball, the tape a little bit and be like, all right, what's wrong with this picture? Well, obviously, you got the S&Ps down almost 40 handles, right? The NASDAQ is actually strong on a relative basis. Volatility is bid, but not that much. But then again, when you take a look at volatility, we've had a couple of wicked days to the upside. Volatility really hasn't necessarily backed off. Obviously, the biggest standout over here, it's got to be the bonds. I mean, this, by the way, this is not the range that's defining the marketplace right now. This is just downright hideous. I mean, this is like, bond Armageddon's going on right now, and it looks like the S&Ps, they just are not necessarily paying attention. Or are they? If you look at the S&Ps today, and they're down 33 handles, okay, take a look at some of the sectors that are in play. The financials are down almost to the tune of about 1.8%. So they're getting hammered. And I'll remind each and every one of you, the financials have had a tremendous bid under them. In fact, when you apply auto expected moves, you can see what does that bid look like? I mean, again, last week actually tagging the upper edge of the expected move, pulling back. This week, I mean, we're almost 2 times outside the expected move. Here we are still. Okay, bid towards the upper edge of the expected move. Nevertheless, again, 1.7% decline is significant. You would think that the S&Ps would be down more. Then you take a look over at the monsters of tech. They're down, for instance, 0.8%. So what gives there? Well, the fact that Netflix, now most of the time Netflix doesn't really have much of an impact to the NASDAQ. In this particular case, all right, I'll hand it to Netflix. It's up about 12%, which is, in fact, okay, why the Netflix is helping, if you will, the NASDAQ kind of outperform. In addition to that, take a look at Tesla. Now, Tesla is coming out with earnings just after the bell, so it's relatively flat. It's kind of out of the equation right now, but it's one of the reasons that the NASDAQ is strong on a relative basis. But what I'm really getting into here in terms of today's tape, it's got to be, once again, the energy sector. The energy sector, if we take a look at, again, auto expected moves, we are outside the upper edge of the expected move. And again, the reason I use the expected move, it's what the option market kind of depicts, risk to be. It's kind of like a way to handicap risk. And right now, 68% of the time, well, we're outside that. Like, bottom line, we are outside that. And if you take a look at the S&Ps and you're like, well, they're down 35 handles. It's kind of bad. Yeah, but you have the energy sector wildly bid. And if the energy sector was flat or even down today, you do realize that the S&Ps, they'd be getting decimated, right? This is actually a little bit of, again, it's a little bit of a warning shot being kind of fired into the marketplace. But before I go any further in here and talk about that range, again, I actually want to drop back to the bonds. This, to me, it's the most troubling thing in the entire screen because a break in the bonds, well, unequivocally, it's got to start to really undermine many of your technology stocks. But today, it's almost like they're immune to it, if you will, okay? Are the bonds going to be able to continue to break to the downside with, I guess, immunity inside of big tech? I would suggest that the answer to that is absolutely not. Nevertheless, again, the whole market right now, it's not being held together clearly by the bonds. And this sell side activity in the bonds, like, hey, another way to describe this, take a look at the TNX. The TNX is the 10-year Treasury, right? This is the actual, the interest rate, which would be 4.127. It's a little weird when you look at it. You're like, no, it's 41. No, the interest rate's not 41. It's 4.1, right, on the 10-year. But you can open up even to a 10-year chart. It's absolutely vertical. I mean, this is, if you will, interest rates are crashing to the upside. You can open up the 5-year in here, see how steep that is. But even under the max chart, you've actually got to go back. Again, you've got to go back in this case, what is it? 14, 15 years to actually see price action, all right, at these particular levels. And in terms of price action, I mean, again, this is just an absolutely vertical move in terms of interest rates. I bring that to you once again, and I've been harping on this extensively because how much more can markets really take? Again, I'm showing you, the ZB, which is down, a point and 24 ticks. For those of you that don't speak bond geek, that's 1 3/4 points, right? These are not just moves. These are catastrophic moves inside, okay, of the U.S. Treasury market. And it kind of feels like today, maybe a little swept under the rug. Now, the single most important aspect that we need to face in the S&P 500 is something I was bringing up extensively in the weekend update. Got to bring it up again today. It is this range, and this range continues to define the entire marketplace. And again, I'm going to freeze the screen. Doesn't matter, there's a few minutes left. I'm going to freeze the screen and box it in once again, because you've got to understand the elaborate mess that we're presently in. 3,600, 3,800. Where are we trading right now? Couldn't be any more of right smack in the middle. And quite frankly, it doesn't matter if we're trading right at 3,000. It doesn't matter if we're trading at 3,800. Whether it's 3,600 or 3,800, it's all the same. We are still effectively boxed in. The longer we're in the box, okay, the more violent the move out of the box is going to be. Now, why is this such cause for concern? Because we're completely and utterly binary at this point. We're going to explode to the upside or we're going to explode to the downside. Now, if you're looking for directional bias on this particular front, well, what I can offer you is simply this. Bonds right now, the sell-off inside of the bond market, clearly, okay, and decisively would lend itself to big-time sell-side activity inside of the S&Ps. And frankly, at this point, I'm a little shocked how well the S&Ps are holding up with the ZB trading at 121.28. Furthermore, if you take a look at the dollar right now, it's right back up there, threatening, if you will, to break, okay, into that 114 or possibly even 115 handle again. I have to reiterate, that range in the S&Ps defines the whole marketplace. But the bonds are breaking down. It's already taking this you need to take, if you will, a defensive stance. The dollar is already back up and threatening to break out to the upside. Both of those, okay, to me would quantify as, well, horrendously bearish at this particular point in time. But before we get ahead of ourselves, listen, you're a trading session away from, dollar backing off, bonds kind of rebounding, and the S&Ps ripping. Nevertheless, we're still trapped, okay, like a rat inside of an extraordinarily, okay, heavy volatility box. And again, I want to reiterate that point that the longer you're in this box, okay, the more open interest, okay, that is going to accumulate. Effectively, more open interest, what does it mean? It means more gamma risk. As we come towards, okay, the latter portion of this week, listen, we have already done what we need to do in the SPX. What have we done? Well, let's actually zoom into the SPX. We tagged, okay, the upper edge of the expected move. And I'll remind each and every one of you here, the expected move, right, this week is plus or minus about 120 bucks. What did we do? Outside of it, pulled back. Okay, most of today's trading session, if you looked at today's trading session, you're like, nothing even really transpired today. But, in the onset, you might think that. And then you look at the edge of the expected move, you go, well, everything transpired. We did exactly what we're supposed to be. This line in here, which in the SPX is effectively 37, okay, 04, that right there, that's kind of a happy place for risk. All right. I'm not going to be surprised at all to see the SPX close in or around the upper edge. Again, the upper edge of that expected move. I mean, hey, look, this is what you should, well, expect in a marketplace. Nevertheless, breaking above it or breaking below it, hey, listen, we're coming into Thursday and Friday of a week that we have a $120 expected move. But I want you to actually take a look at the SPX with me, because some interesting kind of facets here left over that you may or may not be aware of. There is still, okay, wild amounts of risk being priced in here. And this is one where, I looked at it a little bit earlier today and I go, oh, wow, that it kind of actually caught me a bit off guard. Too much usually catches me off guard in the marketplace. But again, here we are on a Wednesday. You've got the Thursday expiration, about a $50 move being priced into the Thursday expiration. Then there's a Friday AM settlement, about a $60 move. And then, of course, a Friday PM settlement. There's still $70 of price action, okay, between now and Friday. So for the most part, okay, volatility, it just has not abated. Like the market sees this wicked range. The market can actually feel that gamma risk just kind of building, right? There isn't a great bias that I'm going to give you outside of the fact, and again, I want you to understand, outside of the fact that, hey, dollars in an extraordinarily defensive position, bonds have sold off a considerable amount, right? Those are definitely bearish. I can't say that volatility is really amped up all that much. It didn't back off, right? It just never really backed off. We are still, okay, for all intents and purpose, you're still in a kind of full-fledged, if you will, backwardation in volatility futures. That still points to a lot more risk. I mean, hey, we could feasibly break to the upside before actually coming back off. Unquestionably, I am still, okay, long-term bearish in this marketplace. But before we continue to allocate capital at this point, recognize how binary this marketplace is going to be in the very near term. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.